Sector rotation seems like a smart move until the moment it suddenly stops working. It looks intelligent on paper, but can fail without warning, creating a real problem for investors. First, the leaders fade, then new leaders emerge but fail to hold, and soon the signals start contradicting each other. Most investors panic when this happens, but professionals do exactly the opposite. Welcome to Money Mastery, your step-by-step guide to financial freedom and building real wealth. This video focuses on one critical skill: protecting your capital when markets turn unpredictable. The real skill isn't spotting rotation patterns. It's surviving and protecting your money when those patterns break down. Let's start with a hard truth about why rotation strategies sometimes stop working. Rotation doesn't fail because the concept is flawed. It fails when markets become uncertain. Uncertainty brings leadership changes, conflicting signals, rising correlations, and volatility spikes. Uncertainty is where capital dies if unprotected. Professionals watch for early warning signs that rotation is breaking down. Leaders stop leading. Everything moves together, and whipsaws increase. These are the progression of warning signs. These warning signs aren't telling you to try harder. They're signaling it's time to protect capital. The first professional rule is to reduce exposure, not abandon your conviction. Reducing exposure means smaller positions, fewer themes, and slower adjustments. You don't need to be right. You need to stay liquid. The second rule is understanding that cash is a strategic position, not a failure. Cash preserves capital, reduces pressure, and creates flexibility when you need it most. Smart money waits patiently rather than forcing trades in uncertain conditions. A third rule is to prioritize defense before offense when signals break down. Professionals shift from chasing leadership to limiting downside, a strategic shift in focus. This means limiting downside, stabilizing portfolios, and reducing volatility exposure in sequence. You can't compound if you're busy repairing damage. The fourth rule is to identify what holds up when everything else is falling. Look for resilient areas, stable sectors, steady demand, and assets absorbing selling pressure. Future leaders often hide here. The fifth rule is to shorten your time horizon when long-term confidence drops. A shortened horizon leads to frequent reviews, tighter limits, and smaller bets. Less certainty requires shorter decisions. It's a direct relationship. Now let's cover the critical mistakes you must avoid during rotation failure. Doubling down, chasing rebounds, rotating faster, ignoring limits, and seeking certainty are all destructive behaviors. Most damage is self-inflicted. The final insight is understanding the professional mindset shift that separates winners from losers. Professionals don't ask how to make money now. They ask how to avoid permanent loss. Survival creates opportunity. Remember these key principles: rotation stalls, signals conflict, capital needs protection, cash has power, and patience is a position. Markets reward those who stay calm when clarity disappears. If this video helped you think like a professional, hit like, subscribe to Money Mastery, and take your next step toward financial growth. Money Mastery is your dedicated channel for building real financial knowledge. Through step-by-step guidance, Money Mastery connects you to the financial freedom and wealth creation you're working toward. Next, we'll talk about how professionals re-enter when clarity finally